Hey, it's Dr. Gold. We left off in the first video. We were talking about the income statement. So I'm going to just skip ahead here to the section that we're up to, which is the balance sheet, the second financial statement. Now, the balance sheet, as we said in the first video, is simply a snapshot in time of a firm's assets, liabilities, and shareholders' equity. It's important to note that it's a snapshot in time because, for example, you may have started out the day having an asset, let's say a share of stock in a company that was worth a certain amount at that point in time. But at the end of the day, if the stock had gone up in price, well, your balance sheet, your personal balance sheet would be different because that asset would have increased during the course of the day. So balance sheets, it's important to note, are good for comparison purposes, good for getting an idea of how the company manages its financing and finances. But it is a snapshot in time and is subject to change over a rather abrupt period in many cases. So you have to be careful when analyzing balance sheets. There is a certain logic to the balance sheet, and as we said in the first video, the accounting formula is essentially listed here again. Total assets equals total liabilities plus shareholders' equity. And we get that because companies all have assets of some sort, and they acquire those assets by either borrowing money through the use of liabilities or incurring liabilities to purchase those assets, or getting people to invest in them, in which case they give those people ownership stake in the company, but those people then give them money to acquire the assets. So that's kind of the logic behind that particular formula. There's a logic within the balance sheet itself, and before we get to it, I just want to go over some terms that you need to be familiar with. On the asset side of the balance sheet, you've got current assets, which are assets that can be relatively and easily converted into cash within a year or less. And then you have what are called fixed assets. They're also assets of great value in many cases, but a little bit more difficult to convert into cash. This concept is called liquidity. The more liquid an asset is, the more beneficial in some ways it is for a company because it can be used to meet short-term obligations that the company might have. Longer-term assets like land or property, are harder to convert into cash very, very quickly. So that's the difference. Current assets, fixed assets. Sometimes fixed assets are referred to also as non-current assets. So there's current assets, there's fixed assets, and then fixed assets are also sometimes referred to as non-current assets. Then on the other side, you've got liabilities. So you have current liabilities, which are amounts of money the company owes to its creditors that will become due in a period of 12 months or less, so 1 year or less. And then you have long-term liabilities, which refers to debts with maturities that are longer than 1 year. Like, for example, if a company has a mortgage on property that may not be due for 20 years, that would be a long-term obligation. Whereas if a company has a bill with Staples because they ordered some office supplies and they haven't yet paid it, but it's going to be due in 30 or 60 days, that's called an accounts payable, and that falls under the current liabilities category. A shareholder equity or stockholder equity is, essentially the amount of money that was invested by individuals to funded the company. But it also can be looked at as if you were to take assets and subtract liabilities, because it is a balance sheet, it has to equal the shareholder's equity. So that's another way of looking at it. You can look at it like assets equals liabilities plus shareholders' equity, or you can look at it like assets minus liabilities equals shareholders' equity. We mentioned in the first video that when companies have net income, after they pay a dividend, if they choose to pay a dividend, they don't always have to. Whatever is left is referred to as retained earnings. And retained earnings gets reported on the balance sheet. And you'll see where that is in a second. Liquidity we've already covered, so I'm not going to cover that again. So let's kind of skip to a diagram of a sample balance sheet. Here you have in the green boxes on the left-hand side current assets, cash, accounts receivable, inventory, and other current assets. And there's a certain logic to how that flows. The cash is the most liquid of those assets. Accounts receivable is money that is owed to you. You might have sold something to somebody, a product or a service, and they haven't yet paid for it. That's called an accounts receivable when a customer of yours owes you money. So while that's worth cash and can be converted into cash, it can't be converted into cash as quickly as cash, so it's not at the top of the current assets, but it's a pretty liquid asset. You can sell accounts receivables to other companies that will pay you for a certain percentage of your accounts receivable if you need cash quickly. You can always, of course, try to collect the money from your customers, which I know as an entrepreneur can be extremely difficult at times. But accounts receivable is certainly a valuable current asset, but just not as liquid as cash. Then you have inventory, which is also considered a current asset. And you'll see later on when we go over the chapter on ratio analysis how one of the ratios will remove inventory from the current assets picture to get a better understanding of whether or not the company can meet its current liabilities or not. And you'll learn about why that is when we go over that chapter. And then you have other current assets, which could just be other things that are of value to the company. Long-term assets, as we mentioned before, could be property, tractors, factories, patents, and so forth. And then on the right-hand side, you've got current liabilities. Again, there's a certain flow to it. So current liabilities are bills that the company has to pay or debts that the company has to satisfy within the next year. So as you move down the liability side of the balance sheet to long-term liabilities, these are debts the company also owes, but they're not going to come due in the next year. So one thing you always want to look at is, does the company have more total current assets than current liabilities? Because if they don't, that's a big problem. It's a problem on a lot of different levels. Where are they going to get the money to pay for those liabilities that they must pay within the next year? It could come through additional borrowing. It could come through additional issuance of stock. It could come through the sale of assets, but like a long-term asset. But it's going to have to come from somewhere. So when we start to analyze balance sheets, you want to look at the current assets and compare them to current liabilities to make sure that the current asset side is larger. Long-term liabilities, as we said, would include things like mortgages on property and long-term leases and things of that sort. And then, of course, you have the retained earnings, the paid-in capital, and the value of the common stock to represent the shareholders' equity. So that's the balance sheet in a nutshell. We'll pick up video number 3 and go over the cash flow statement to finish out this chapter. I would recommend that you watch the other videos that I have on Blackboard for this chapter, and also to do some of the practice questions at the end of chapter 3, which I think really will help you to gain a deeper understanding of financial statements and sort of where different pieces fall, because that's kind of important to understand as we move forward trying to value companies.